Hello, friends. Mic check. 1 2 1 2. It's a beautiful day. I see a few of you in the chat already. Looks like we're ready to do this. You know what? We're going to gamble that it's already working, and we're just going to fire up the intro. Let's fucking go. Hello, friends. Welcome to Alpha Beta Soup. I'm TXMC. It's Friday, November 17th, 2023. It's 11 a.m. in U.S. Central Time. Hello, everyone. A lot of friends in the chat. Smash that like button if you haven't already. Great to see everyone. So, well, it's been kind of a choppy week for Bitcoin, but there's a few things we can talk about. I'm going to look at the markets a bit, and then there are a few things related to some credit data I want to talk about because it's where I've had a lot of my attention focused in the last few days. So we're going to look through some of those things together. I haven't reviewed all of the credit data, so you and I will be looking at some of it for the first time together, and you'll get my genuine reaction to some of it. But you know, we're in an interesting spot with BTC. The uptrend has been maintained. I do still think we're drifting higher no matter what I think about recession. It's kind of obvious that the uptrend is intact so far. And I really do think BTC wants to go higher and that it wants to find out what lives above 40K. That's my general bias in the short term. But, you know, the path to getting there is a little uncertain. So I was watching this action yesterday, and I actually tweeted about this, that I was looking for a long setup. And when I sent out my tweet, what I was actually looking for, so BTC was, it had already made this wick right here. This wick this was Tuesday. And I was thinking, okay, well, this came down here on Coinbase. It didn't break these lows, didn't break the low from last week. And so what I'd really like, you know, ideally, I'd love to get a sweep of these equal lows right here. And maybe even these equal lows over here. And I tweeted that out at the time that I was hoping to see something like that, or maybe even come down here, do one of these. And then I would look for the top of the range just to kind of sweep these and sweep all of this here. Well, Bitcoin, as it is prone to do, said, nah, son, we're just going to take off. And so it ripped all the way to the top of the range. And when it got up here and it started to pull back, I said, all right, maybe I will get my long opportunity, but maybe it won't be down here. You know, maybe I need to look for something in this area to then go higher towards the top of the range. So, you know, I started looking at this. I noticed that we really had caught support. Now, this is before we got here, right? Like this is, if we rewind some of this, let's take this back. It's about like right here when I'm looking at this chart yesterday. And I was thinking, okay, well, we kind of held support here right at this quarter point of the week range. This is the range of last week, the low and the high from last week. And so we kind of found support right at this quarter mark. And we established a bit of a demand zone. You see this consolidation before the up thrust, these multiple candles here. And so I kind of drew this out on my chart. I didn't tweet this out before I took the trade because I'm not really trying to give like real-time trade signals. But I was looking for a retest of that, and that's exactly what we got. Let's take off replay mode. Sorry, here, messing with my drawing tools. We got a perfect retest of that zone. So I actually went long on this wick right here. Let me zoom in on it a little bit. I just did a market long down here somewhere when we were below this level with half my position. Not really knowing if it for sure was the low, just betting that the odds are that it was the low, considering the structure here, considering that if it was going to if this retest here was going to go all the way up and then come all the way down and actually go below this wick, then it's hard for me to maintain a long bias in this range here. I would expect it to take these out, and then who knows. But if we're going to maintain the uptrend, if we're going to maintain this structure, then this low really needed to hold, especially the way that it formed right here on this level and that we had established this demand zone. So I took a long inside there. I'm just giving you guys the detail of what I did yesterday because I thought it was a good trade. So I went long here. Once we broke out, I set a limit order on this line right here for the other half of my position. It got filled right there. And so now I'm long. My stop is down here around 35,200, which is right around this level. My stop's right around here, maybe a little lower. And I'm looking for the top of the range. I'm looking for 38s and then beyond. So right now it looks like it wants to give me that. Got a nice little bounce. We're holding structure. We're not coming back down. We should not retest this zone again. Ideally, we should not. If we do, it should be the barest kiss, just a butterfly kiss. We shouldn't see action down in this zone. If we start seeing candles forming down in here, I'm just going to cut the long because it's not what I expected to see. But if it is, if I'm right, then we're looking at like a 5R trade. So here's my stop. It's somewhere around here. I'm aiming for up here. See, about 5R. That would be my first profit take. And then my next one would probably be up here around 40. We'll just see what happens. But I'm long Bitcoin right now. It feels good to be long the corn. I mean, I've always been long. I have a spot bag. Even though I'm bearish, I have a spot bag. I'm not an idiot. But I'm long right now, and we'll see how that goes. I had longs on a couple of alts that I took that were just kind of degen longs. They didn't set up quite as well. But I had originally, after I took this long on Bitcoin, which was super clean, I took just a random long here on TRB, thinking that maybe it was going to hold this support right here and follow Bitcoin along. But I ended up cutting it this morning for a scratch just because I didn't like my entry. I didn't feel too convicted about the trade. So I just got out of that, and I'll just wait for something cleaner. Maybe if it gets back up above this level here, maybe I'll look for something in this area to go long back to the top of the range. I don't know. But that's just like a random alt trade. Who cares about that? But over on equities, I have the opposite bias. I'm currently short the NASDAQ and the S&P because of what they've set up to show so far. So here's the NASDAQ. This is the July high, which is not the all-time high. But this is the July high, and this was the pivot just below the high. And yesterday, I took a short on the NASDAQ. I'm still holding it with a stop at the high, looking for this range here, getting back down into last week's range. Maybe these lows. I would take profit here and then somewhere down here. But based on the fact that we swept this high, this area right here, and it's the local high, I just decided that's a good spot for a short. And on the 4-hour, my confirmation was this candle right here. See this candle? As soon as we closed underneath this high, I opened my short with my stop up here, and I've been holding it. And you can see we haven't even gotten above my original entry. We haven't even gotten a candle close above my original entry. If I saw some candles up here, it would depend on the action. But if this started to build like this and looked like it was just grinding up, I might reduce my position. I don't know that I would outright cut it. I'd probably wait for it to get above this. But I wouldn't expect it to threaten this level again based on the fact that we just swept what is arguably a pretty significant local high. So we'll see how that plays out. The setup wasn't as clean on ES. ES didn't get that close to its high, but it did get into this supply zone right here, which marked the sharp move down. So in this side of this daily candle right here, ES has gotten up and swept in here. It looks a little more bullish than the NASDAQ. Like if you're just comparing these two, candle for candle, the NASDAQ hasn't reclaimed as much of the pullback. ES looks a little more bullish. So I actually have a slightly smaller position on ES just because the setup wasn't so clean. But if the NASDAQ is going to break down, and I'm correct, if it's going to at least fill in this right here and get back down to this range, I would expect ES to follow. So that's why I decided to take a trade on both at the same time. But those are currently my positions. That's all my open positions, not counting my spot bags. But this is the kind of place where after a really strong bear market rally, I mean, forget the fact that I characterized it as that. It's just a move higher. After a really strong move higher, basically a 10% rip on ES, it would make sense that it would soften for a few days, that it would at least cool off. It's not just going to go up forever. And this is a good place to find some resistance. So, just logically speaking, it's not a bad short setup back down to like this level at minimum, even if it does continue higher. So we'll see how it plays out. But I do think it's kind of funny. After we had this massive move, right? And the same thing was true on the NASDAQ. Yeah, I think it was an even bigger move on the NASDAQ. 13-14%. After a big move like that, that's when everyone starts getting bullish. So like we go look over here is Eric Balchunas. He works for Bloomberg. And he tweeted this. I was just talking about this with Blockchain Backer before my stream. We were texting a little bit. And he sent me this tweet, and I just think it's so funny. ETF flows this week were massive. QQQ, which is the NASDAQ, took in $7.5 billion since Monday, more than any week since its launch in 1999. So this is the most bullish inflow week in dollar terms in QQQ history. And the only week that even comes close is middle 2020. I just think it's funny that I shorted the NASDAQ on the week that everyone got crazy bullish on ETF flows. And at the same time, I think Helen Meisler, she just tweeted this out a little while ago, something about put call ratios. Yeah. Thursday's put call ratio was 0.81, the lowest since January. So everyone's buying calls. Everyone's buying calls. Everyone's piling into QQQ after a massive rally into resistance, and that's where I decided to short. So maybe it'll work out. It certainly feels like a contrarian call, but that's not what my trade is based on. My trade is based on technicals. My trade is based on a candle close back underneath resistance. So we'll see how it plays out. But it's funny how the market tends to do exactly what you think it's going to do after a big move. That's when everybody gets really excited. Anyway, DXY had a big move down. We've been watching this as a continuation of Wyckoff accumulation, right? This was sign of strength. And I had said that, if we're going to continue back up to these levels, ideally, obviously price can do whatever it wants. But in an ideal world, you wouldn't want to see a lot of action down here after we got to this level, maybe like a little kiss, but then we should just keep going back up into these highs. But it's not what we're getting. We've gotten a really strong move back down below the quarter point of the previous range that DXY was in. And in fact, it's like a really big, ugly weekly candle. It's the biggest weekly red candle since back here in July when it marked the low, and we called this a Wyckoff spring. We'll see what happens. It hasn't really been, this weekly move here hasn't been the nuclear lift to equities that people kind of just naturally assume will happen with the DXY. And I think that's because it's coming from an elevated level, right? Like maybe if we saw this candle down here somewhere, it'd be more of a lift. But where it is, it broke down from 106, which is kind of a dangerous spot for the DXY going back in time. So that might be part of it. There also seems to be in certain pockets of the market some elevated fear. There's been a bid across bonds all week, the last couple of weeks really. There's been a bid across the curve in bonds. Some of that is in anticipation of the Fed cutting. Some of that might be growth concerns because Japan had negative GDP. We know what's going on in the Eurozone and the UK. They're looking a little sus. We've gotten some kind of suspect data this week that might be fueling certain people's recession fears. But either way, just kind of watching what's going on with the DXY. I don't have a strong opinion about it here right now. But if it gets down below the midpoint, then I think that this move here is over with for now and that we should look for lower on the DXY. Okay, so I've been looking through the data. That's all I want to say about the market for now. We're going to talk a little bit more. I want to talk about the recession, and I want to look through some credit data with you guys. I don't want to spend 30 minutes talking about the market because I think that there's some interesting things to talk about. And, a couple streams ago, we looked at some of the labor components and the rate of change of them. This is some of the ones we looked at. At the top here, this is temporary workers. In the middle, this is job losers, people who were fired. And down at the bottom, this is unemployed. So just everyone who says that they lost their job and are looking for a job. These are the people that make up the unemployment rate. And the rate of change of these metrics, as you can observe, is in recessionary territory for all of them. All of them are well beyond rates of change that we see in expansions. It's obvious on all three of these metrics. When we look at other components like bank loan growth relative to when the Fed started tightening compared to all prior eras, we see credit growth has slowed down faster than ever before, right? This is something we've talked about off and on the channel here for the last few weeks, is the massive slowdown in credit growth. And I think that we're starting to get to a place where even though we have positive job growth, here you can see the rate of job growth is 1.6%. Even though it's still positive, I think we're getting to that place where a couple years from now, when we look back, this moment, this month, and next month might be around the time when this gray recession bar actually starts. Now, I say that because various components are already well into recessionary territory, even though other things aren't quite there yet. And usually at the beginning of a recession, it's not obvious. It often isn't obvious for several months into the downturn. It's usually, as we've explored together on the channel here, if I go show you labor relative to the yield curve relative to recessions, where is labor? Oh, sorry, here, we'll look at this one. My charts are a bit of a mess. This is the growth rate of jobs relative to when recessions start here in this vertical bar. And you can see that on average, it's about 2 months into the quote unquote official recession start when the rate of job growth on average goes negative. That's true for non-farm payrolls, and it's also true for the household employment survey, which are the two components that determine labor. Both of them, it's about 2 to 3 months into the official recession when you start to see that fall. And before then, job growth is about 1 to 1.5% on average. Well, what did I just say it was? I just said it was 1.6%. It's slowing down commensurate with prior recessions, which is something we've talked about. If I go show it to you over here, here's the rate of job growth. This gray line is prior recessions. We've been following it. So if these things continue to play out, and if nothing really interrupts our thesis over the next few months, then I think it's highly possible. I won't say that it's my base case because I think I'd like to see a little more data and feel more confident about it. But if I'm thinking about a year from now or 2 years from now, when we've got enough data for the NBER to make an official declaration, I think that November or December of 2023 could be around the time when they say the recession began. So that doesn't really have implications for us, for the way that we're studying this. But if we're correct about where we're headed, and we're trying to anticipate it before it becomes obvious, this is kind of around that period of time, right? Where we're just a few months away from the period of time when jobs would be expected to slow down significantly, or at least to the point where their rate of growth is basically nothing. We've been following that trajectory. When we look at some of these other labor components, you can see they're all accelerating, which is what they do early in recessions. Go look at the rates of change leading into the gray bars, and look where we are. Leading into the gray bars, and look where we are. Same thing here. Leading into the gray bars, look where we are. So it's not an unreasonable thing to say. And the stock market won't tell us that that's the case, right? Because it's often the case that the recession begins and then the market continues to go higher for at least a period of time. Let's look at that together real quick. Let's put the S&P on here. Weekly's fine. Let's throw on the recession indicator. I mentioned this before, but if you have TradingView, if you go to indicators and you type in my name, TXMC, There's 2 or 3 of them that you're welcome to use. Recessions will give you the bars for official recessions. Ignore whatever color I have by default. I think it's red by default. And you can add those indicators. I have a couple of other ones. I have one that shows the Treasury yield curve, the 2s, 10s yield curve, and I have one called the Mayer multiple bands, which is for Bitcoin. But anyways, so if we go back and we look at the recessions, the market isn't just like, oh, the recession started, let's go straight down. You know, there's a reaction function, there's a process to it, and there's a delay. And, here back, the recession, quote unquote, officially began at the beginning of 2008, December 2007, somewhere around there. But the market had a strong retrace bounce in April, and this was after Bear Stearns went down. And the market still pumped. This was a 15% move on the S&P, 17 years ago, 16 years ago. Same thing over here. The recession in 2001 maybe isn't the best example because it was relatively brief and it was already after the tech bubble popped. But we can go back in time and find plenty of instances where the recession began, but there were still moves higher in the market. It didn't just begin and the market went straight down. It's a little bit more dynamic of a process. And those are just the official dates, right? Recessions are a multi-year thing, a slowdown, the end of a financial cycle is a multi-year process. And even when they date the quote unquote end of the recession, a lot of times unemployment continues rising well after that period of time, right? Like it's not like everything reverses on a dime when we get the all clear that the recession is over. You can see that here. Like, let me zoom out. In a lot of these cases, see, the recession ended and then unemployment ticked higher. Recession ended, unemployment ticked higher. Recession ended, unemployment kept going. Recession ended, unemployment kept going for a couple of months. Here, in 1991, the recession was over in April. The high of unemployment was June of 1992. Here in 2000, the recession ended in December of 01, November of 01. But the bottom of the market was another, year later, and the high in unemployment was a year and a half later. Same thing with the GFC. Bottom of the market was March 09. The high of unemployment was September. So it's very slow moving. And you can see that over here. If we look at, this is jobs relative to the Fed tightening. And you can see where the solid line ends is when they stop tightening. But the dotted line ends when the recession is over. And you can see that the job growth just keeps on slowing after the Fed is done tightening. Here in 1990, look at this. That was one of the run rates where I said, if we go back here to 1990, where unemployment just kept rising after the recession was over, even after the market was already recovering. But what was happening? Job growth was still slowing for a really long time. The Fed stopped tightening here, and it was another 20 months of slowdown in job growth before, the end of the recession. So it's a very inertial process. And that's why I think it behooves us to think now, looking forward, okay, if we do have a recession, we're not that far away from when they say it would have began, even though we don't have a negative non-farm payroll print yet. And maybe we won't have one for another couple of months. I don't really know. I could also be dead wrong. But if I'm just kind of looking at rates of change compared to previous eras, we're right at that sweet spot. And I have to say it. But what I want to talk about now is I want to talk about credit and the consumer a little more. I've been looking at some data. There's been a few reports that have come out recently. And what we've been talking about on here, as I said, is this slowdown in credit and how in an economy driven by consumption, there are only a couple of sources of new demand, right? People's incomes, whatever they have saved, and debt. Those are the 3 inputs to new demand in the economy. So if you choke off one of those things, credit here, then that leaves savings and incomes. Well, if savings are being depleted because of higher costs, well, that is something that is soon to go away as like a force, right? If we see savings coming down. And in fact, if I go look at the If I go look at the Fred site and we look at personal savings rate, I bet it's come all the way back down. Now, this is a flow metric. It's not a number of dollars. But you can see the personal savings rate, it started to rise last year, but it's fallen back down. And now we're well below basically the entire post-GFC era in the rate of savings, the rate of disposable income that isn't used, right? So savings is not necessarily a mechanism we can trust for new demand going forward. And then credit, another mechanism, has been choked off. So that really just leaves people's incomes as the last leg of the stool to sustain the economy. And so I think it's important to look at how stressed consumers are, how much money they're actually spending, and what we can glean from that as maybe like a pool temperature of just how hot or cold the consumer really is. And the reason is because credit is probably the most effective transmission mechanism to send rate policy into the economy. So like when the Fed starts raising interest rates, when they say, okay, we need to raise rates for whatever reason, they start hiking the federal funds rate. And then there is a whole channel that takes that federal funds rate down to the consumer buying things at the store, the business spending on investment. There's a whole channel there. And it largely goes through credit. That's the transmission of the cost of money. And so when we have credit choked off, it really limits like I said, the new sources of demand. So when we look, there's been a lot of talk lately about delinquency rates, and for good reason. I decided to chart some delinquency rates on credit cards, right? Because we know that business credit has been choked off. That's what you're seeing here, business credit. But consumer credit has not totally slowed to like Armageddon levels, but it's slowing dramatically and more quickly than most prior eras, except for just a couple of them, except for the Volcker era here in turquoise and the GFC here in pink. Those are the only other two times where consumer debt slowed as much as it did. So we still have people using some of their credit card debt, some of their available credit lines, but delinquency rates are rising. And a lot of times when people see delinquency rates, they look at the absolute level of delinquency rates and they say, oh, it's no big deal. You know, like if you look at the credit card delinquency rate of top 100 banks, it's all the way down here. It's no big deal. It's all the way down at, 2013 levels or something. That's true. But what concerns me also is rate of change. And this acceleration here is something we don't see that often in the data. And so it could be a harbinger of a dynamic that will play out over the next few quarters. This is a quarterly number that we get. And I would be watching delinquency rates at the larger banks to continue climbing because this rate of change is not like this. It's more akin to a recession. So that's concerning. But then if you look at banks outside the top 100, these are banks that tend to service subprime borrowers, people who aren't as credit worthy, people who don't necessarily have as much income. Because if you have pristine credit and you're a top earner, then you can go get the best terms from like JP Morgan. You don't have to go to Bob Smith National Bank in like your local town. A lot of small businesses use smaller banks, and just generally middle and lower income consumers use smaller banks on average, right? It doesn't account for everyone. But look at the delinquency rate of credit cards at smaller banks. All-time highs. Above the GFC, which was right here, above 2000 and 2001, the tech bubble, above COVID. That's an ugly dynamic, and it shot higher. It's been a little slower moving with the larger banks, but that dynamic has me a little concerned. So that caught my eye. I thought that was something that we should point out here. And then when we think about, okay, what about debt service payments? Because what really matters when it comes to debt isn't the total absolute level of debt. Like a lot of times on Twitter, you'll see people sharing, well, consumer debt reached 1 trillion for the first time ever. But if you look at the consumer credit number, it's always going up. It's just perpetually going up. So that doesn't really mean anything. 1 trillion, 1.1 trillion credit, like who cares? What really matters is How expensive is that debt compared to people's incomes? What is the likelihood that they can service that debt? Well, on the one hand, mortgage payments are relatively low because millions of Americans have fixed rate mortgages. So the only people who've really been affected by interest rate policy of the last year and a half are people who've taken out new mortgages, and the very small percentage of Americans that have variable rate, adjustable rate mortgages. Most people have 15 or 30-year fixed. And a ton of people refinanced in 20 and 21, and they're not going to have to touch that for another decade. But if we look at the other components of debt, take out mortgages and look at non-mortgage consumer debt as a percentage of their disposable income, that's this line right here. So that's representing credit card debt, auto loans, personal loans, all of those things as a percentage of what people take home and their disposable cash. And it has essentially doubled from its lows in March of 2021. The rate of their disposable income that is consumed by non-mortgage debt payments every month has jumped from the low ones to 2.7%. That level is commensurate with the worst parts of the great financial crisis. That's not a good dynamic. This is not the largest piece of consumer debt. Mortgages are the largest piece of consumer debt. But this rate of change right here is going to be a problem for certain people. For the amount of money that you have to put towards your credit cards every month, to have for that chunk to have doubled as a share of your extra income over the last 2 years is a major hit to people who don't have a lot of disposable income. It's made worse by this collection of red dots down here, which represents the average national credit card rate, the national rate, interest rate on credit cards at major banks across the United States. That, for most of the mid-90s until COVID, was below 16%. But since the Fed began raising rates, that level has been shooting higher. The average rate on credit cards on a national basis now is almost 23%. Like the highest that we've ever seen in this data. And I don't have any data that goes back further than this to compare to prior eras. I would love to see credit card and just loan interest rates, not treasury rates, but actual bank loan rates from back here in the 60s and the 70s. But I don't have that data here. I'll try to look for that. But over here, this is major pressure on the consumer. We've got people who are already levered up over the last couple years. They levered up on credit, but now that rate of credit, the penalty rate for them is 23% on average. And the debt service cost of their non-mortgage liabilities has doubled in the last 2 years. That is a big problem when you consider that credit growth has essentially halted to zero. And all that is remaining to keep people afloat is their incomes and their savings. That's a major concern for me. I've been paying a lot of attention to this. And it worries me because of the dynamics between credit and unemployment. So like if we look at the rate of slowdown in credit the rate of slowdown in credit in all of the prior recessions, which are these tables going from left to right, and then we compare that to when did unemployment start ticking up, there is a delta between the two. And that delta is about 6 or 8 months. So from about the point in each prior era where the blue line rising is the slowdown in credit, if you pause my screen and you look at the axis over here, this is the credit axis, and you'll see it's becoming more negative going up. It's inverted. So the blue line rising is credit growth slowing down. The orange line rising is the unemployment rate, which is over here on the right axis. But once credit growth starts slowing down, there's about a 6 to 8 month gap in most eras before the unemployment rate starts ticking higher. Because as I said, credit is one of the primary mechanisms for demand. So if you choke that off, all that's really left for businesses and for consumers is incomes. And that puts a lot of pressure on that part of the economy. Businesses have to start cutting back, job losses rise, and then we have a recession. It's kind of an inevitable process sometimes. And so when I see the slowdown in credit, I start thinking about people's jobs. So let's look a little more at that. Let's look at the household debt and credit report that comes out of the Fed every quarter. They just released a new one a few days ago, and I've wanted to look through this to get a little more color to back up some of the dynamics we're looking at over here with really high non-mortgage debt costs, with 23% average credit card rates, with rising delinquency on credit cards at all-time highs for smaller banks, but rising for the larger banks. And then knowing that when credit finally gets choked off, it's only about half a year before unemployment really starts ticking up. All that's concerning to me. So let's look through the household debt and credit report real quick. This comes out of the New York Fed every quarter. This is free. You can go download this from their website. It's got a bunch of charts. I've looked at this before, so I kind of know which charts I want to find. Here's one of the really interesting ones. This is mortgage originations by credit score. And when we talk about rate insensitivity in the economy and how interest rate policy, there's a lag to how it affects people, and how the housing market is one of the places that is not really being affected by rate policy because of all those fixed rate mortgages. That's right here. You see this big swell of blue bars? Oh my gosh, not my yellow one. This big swell of blue bars right here. This is people with a 760 or better credit score taking out new mortgages starting in 2020 and going through 2022. This is the refinancing wave and the migration wave that began from COVID. A bunch of people got stimulus checks. They were all sent home from their jobs. Many of them were told they could do remote work. And a bunch of people moved or bought new homes. The Airbnb thing took off, so a bunch of people just straight up bought to rent. To become landlords. And we had a massive surge in new mortgages. So everyone who got a mortgage in this window right here isn't going to need to refinance for a long time. And a lot of those people had good credit. They had good credit and high incomes. But let's keep moving here. What I want to see is transitions into delinquency. Here, before I get there, here's another look at credit. So you know how I said people they have access to credit, but they're not wanting to tap it because rates are 23%. Look at this over here. These dark blue bars is the national balance on credit cards in trillions of dollars, right? The credit balance is now over this one. It's now over $1 trillion. So you're getting all the tweets saying credit's over $1 trillion. The lighter gray bar up here is the amount of credit available. Untapped credit. So this is tapped credit, carried balance. This is untapped credit limit. And you can see it's also been rising. So consumers actually have a ton of credit available to them, more than ever before. And this ratio of balance available to balance used is also the best that it's ever been in this data series. However, interest rates are the worst they've ever been in this data series, so no one wants to use credit. They will if they're forced to. If these people lose their jobs, we will see most likely the balances ticking up in some cohorts because people will have no choice but to buy their groceries with their credit card, which they are currently trying to avoid doing at all costs because they're going to pay 23% APR. Here we go. Percent of balance, 90 plus days delinquent by loan type. The blue line is credit cards. We see a ticking up in 90-day delinquencies. The rate of change is concerning. It hasn't broken highs, and none of these other lines seem to be ticking up yet. So that's not a huge concern. Here we go. So I have seen this one. I tweeted this one the other day. This is one of the only ones I've seen on here. So this is showing transitions into 30-day delinquency by various loan types. Credit cards are blue, auto loans are green. Look at these rates of change. See that? Look at how quickly the blue line is rising. It looks like this period here, which was the great financial crisis. And if you'll notice, the recession began here. This is when the great financial crisis began, Q1 of 2008. But before then, the blue line was rising in here, inside where my dark circle is. I know I'm scribbling all over this chart here. Just bear with me, guys. You see this rate of change in credit card delinquencies rising off the lows in a determined way. It looks a lot like this, doesn't it? It does not look like this. It looks like this period here. And it actually looks like the depths of the recession in rate of change terms. But just looking at that right there and seeing this blue and green line over here makes me not feel good in my stomach. That's not a good appearance. And that's just 30-day delinquency. That's not even serious delinquency yet. So that's not a dynamic you want to see. You'd really like to see these slow down and just kind of be doing this. You don't want to see them shooting up that way. Rates of change like that are never good. Here's the same thing, but 90-day delinquency. So rather than 30, they're seriously delinquent. Look at that. Look at that. See the rate of change? That is pre-recession rate of change. And again, if we draw our line, this is roughly, right in here is roughly when the recession, quote unquote, officially began. Delinquencies were rising for a whole year before that. And that's what we've had here. So these dynamics are unambiguous. You can look at the S&P and say, there's no way we're having a recession. You can look at, Atlanta Fed GDP now. There's no way we're going to have a recession. Well, recessions are nonlinear. We don't just ease our way into one and it just happens on a very gradual slope. They are a nonlinear phenomenon. Things are fine and then they suddenly aren't. Unemployment is fine and then it suddenly isn't. Credit is fine and then it suddenly isn't. So it's hard to model. It's not something that you can just wake up on a Tuesday and they tell you the recession began. It's something I've said on this channel many times before. I can't emphasize that enough. But when you look at rates of change across the economy, when you look at the rates of change of people losing their jobs, the rates of change of people unemployed, the rates of change of temporary workers losing their jobs, all those things are concerning. Then you look at the rates of change of credit delinquencies. When we have credit completely choked off, credit growth is basically zero. And we've got all these people with massive amounts of credit available to them, massive amounts of it here, but for some reason, they're just not using it. Well, not for some reason. That reason is obvious. It's because the interest rate is 23% on a national basis, and they don't want to. They want to just use their incomes. So as long as they have a job, and they don't become one of these statistics over here, then they will continue to be able to spend. However, there are some dynamics of the consumer itself that might suggest we're getting near the end of that. And that is from the Bank of America Consumer Checkpoint report. If you want to look at this, just Google Bank of America Research Consumer Checkpoint. They put these out every couple of months. It's free. This one was from the beginning of November. They have a lot of credit card data, right? They're a major bank. And so they track spending across the economy, and they also have certain control groups that they've been following for a couple of years that they use as a sample, kind of the way the Fed has a thing called the Red Book, which is a group of stores that they track the sales for year over year. Bank of America has been doing that with some consumers. So what do we see with consumers? Well, let's look at this chart right here. Right here. This chart shows total card spending per household year over year on things, services, including restaurants, retail, excluding restaurants. And what do you see on the rate of change? Well, since December, basically, the rate of spending on everything that's not restaurants has basically been negative on a year over year basis. Total card spending, which is the blue line, which is just everything, has been essentially flat. The only reason that it shows any positivity is because people are spending on restaurants, right? They're going out to eat. They're going to the movies. We have seen that in restaurant spending data from some of the groups on Twitter that put out data like that in similar reports like this, corroborating high spending in things like restaurants. But if we look at total card spending by income groups, we can see that most of them are flat on a year-over-year basis. Most groups, high incomes, middle incomes, low incomes, their spending growth has basically slowed to a crawl. They're not spending more than they did a year ago. They don't want to, or they can't. And this chart right here, I think, tells the story of how much people have extra in their bank accounts. This is after-tax wages and salary growth by income group, right? So it's, how much, no, this isn't the chart I think it is. Sorry. This is just income growth. But you can see the rate of change of people's incomes has come back down to the pre-COVID average. We had this huge swell here for about 2.5 years of people having 4, 5, 6, 7% income growth. And this group from Bank of America, their rate of change has come all the way back down, essentially matching the pre-COVID average. That also makes sense when you think about inflation. So CPI has been falling during this period. Income growth has also been falling. But there was another chart I want to see, and it might not actually be. Yeah, so what am I looking at here yet? This is showing, here's another one of people's spending. This is total card spending, excluding rent on a year-over-year basis. So even if you take out people's rents, if you say, oh, well, it's just because rents are going up. Well, if you take that out, people's spending growth is still flat on a year-over-year basis, basically since the beginning of the year. So there's no actual growth on people's spending. Here's the chart that I was looking for. This was the one I wanted to make a point about. So this is savings and checking balances. And it's an index, meaning that the number 100 is fixated upon January of 2019. So if you see a value of 140, that means that it is 40% higher than the starting point of January 2019. Well, over here, we see people of 50K, people of middle income, and people of 100K better incomes. And this is the amount of money in their bank accounts relative to before COVID. This is before COVID right here. You can see that, excuse me, I got the hiccups. On average, there's about 40 or 50% more than there was before COVID in the average savings and checking aggregate balances for Bank of America customers. This isn't all of the country. There are probably other banks who have different dynamics. Smaller banks may have a much lower percentage of higher incomes. All that stuff needs to be considered. Bank of America is using this chart to say, hey, look, we're still elevated. We still have an elevated amount of savings relative to pre-COVID. Well, pre-COVID was almost 4 years ago. So I don't really know how relevant that is. I see this differently. I see this as having returned to the middle 2020 area on extra savings, on excess savings. What created this swell right here, the initial swell in savings, was the first of the 3 stimulus checks. That one went out in March of 2020. The next one came out in December, and then there was another one in March of 2021. They were over in this area. But this right here was the first stimmy check. And what this is telling me is that the excess, quote unquote, excess savings of everything that has happened in the last 2.5, 3 years, all the way back to the summer of COVID, all of that has been spent away. And all that really remains is part of the first stimmy check for every income cohort. That's it. That's the only thing that's left that's extra. And we see that while also noting everything we've just said about credit, about the inability to tap credit balances because of a prohibitive credit rate. All of that is concerning, and excess savings are all the way back down to basically where they were at the first stimmy check. But the stock market is significantly higher. That's not a dynamic that I really think is very sexy. I think that the excess savings narrative is pretty much tapped out. And depending on what happens with student loan payments over the next few months, that could bring this down pretty swiftly. So I found another report from Bank of America that is specifically about student loans. And they had some interesting data in here. I'm going to go find it for you real quick. Yeah, so what they noted, what Bank of America found, because they can see where people are spending. They can see if you're spending on your student loans. And what they noted was before COVID, if we consider before COVID to be 100% of households with student loan payments, how many of them stopped paying when student loan forbearance kicked in? Well, this number dropped from 100 down to 50. So about half of them, about 50% of student loan borrowers within the first few months took them up on their forbearance. And then by the time we got into 2023, that number was about 70%. But before that, before student loan forbearance, back during this period here before COVID, the average payment was about $550 per month. Oh, sorry, that's not the first one I circled. This number over here. The average payment was about $550 per month per household. So about $500 a month was being spent by 70% of student loan borrowers 3 years ago. And they haven't paid any of that on a monthly basis since then. And they're just about to now. I don't know what that means for people. I don't know how many people can withstand an extra $550 per month assuming they resume back to the same pace that they were at. I think there is a ramp. I think there's a period where people can pay less than their like average payment, and then it builds up. But I don't know the terms of that. I don't have student loan debt myself. But $550 a month is a lot. A bunch of people haven't paid that for 3 years, and they're just now in the last month or two starting to pay that back. So I don't really know how that's going to affect the ability for people to pay. But if you look over here, this is showing people starting to pay again, households making student loan repayments. And that number has grown by, it went from 100 up to 250. So it grew by 1.5 times the average amount that these people were paying from before. So will they get back up to $550 a month? I don't know. I would assume so. And if they're already doing that at the same time that consumer non-mortgage debt service has doubled as a share of their income while student loan forbearance was a thing, like this whole rise here happened when no one was paying their student loans. And now we're here and they're all starting to pay them again. And there's a group of people who this is going to hit the hardest. And it's the lowest incomes who decided to defer paying their loans. So the people who stopped paying their loans, first of all, look on this side. This is bank deposit balances from all customers, and then customers who stopped paying as of April of 2020. And what you can see is that the people who didn't pay their student loans from the lower incomes, here, and here, they actually have less savings than the people who decided to take up the government on forbearance. So who didn't do that. So there's people who decided to keep paying their student loans. Sorry, I'm getting my words jumbled here. There are people in the lower incomes who chose to continue paying their student loans. And those people, it appears, are just naturally more financially responsible. Those same lower income people who chose to continue paying their student loans, as of today, they have about 15 to 20% more money in their bank accounts than the same income people who did take up the government on forbearance. So there's a group of low incomes who said, yes, I will be glad not to pay any of my student loans. And they used that as an opportunity not to save more money, but to actually deplete their bank accounts relative to people making the same money who did keep paying on their loans. That group of people has elevated their spending. So the red line here is the blue group over here. Bank of America really fucked up by switching the colors on two charts that are right next to each other. That's a major gaffe for a chart maker. But the blue group, I'm sorry, the red group, the blue group over here is the red line. So the people who stop paying their student loans, they have less money in their bank accounts. They chose to spend more of their incomes over the last 3 years for whatever reason, and their spending has been elevated relative to the people in the same income group who... I'm reading it backwards. I read this chart backwards. Let's just forget that. This chart is showing that people who continued paying their student loans, their spending is elevated by a factor of about 40% from people who chose not to continue paying their loans. So the group who decided, I'm going to keep paying on my student loans, their spending went up. But at the same time, the amount of money in their bank accounts also went up. So there is a group who said, you know what, I can't afford student loans. But at the same time, they also didn't really increase their spending. And so those people are going to get hit by payments, but that's going to just bring this level down. And they're going to be back down to their spending levels from, their elevated spending level is going to be hit. My brain's all jumbled because they switched these colors and now it's getting me all dyslexic on these charts. Sorry about that, guys. Let's just forget that. But let's bring it back to what we were talking about. So broadly speaking, there's a bunch of people who didn't pay student loans for the last few years, and the average payment was $550, and we know that they're going to start paying again soon. At the same time, we've seen that most of the elevated savings has come back down, and all that's really left is kind of that first stimmy check worth of money from early COVID, and that's corroborated by the Bank of America data. At the same time that we see a lot of credit stress in the consumer, and this really hits the middle incomes more than the upper incomes. People who make 100, 150K a year or more on average have a better handle and ability to pay, basic necessities of life. So there's definitely people living this experience differently, depending largely on their incomes. And I just have concerns here because a lot of the people who refinanced or who bought new homes in 2020 and 2021, they're not the people on the lower incomes on these charts down here. Like, they're not this group. This group that makes 50K or less are not the people from the household debt and credit report that took out massive, cash out refis in 2020 and 21. So, it's kind of a shit show here. I know I've been bouncing around a lot. I really just wanted to look through some of this data together, and I told you I hadn't reviewed it all myself. So, sorry for kind of getting jumbled on that chart, but I think we're reaching a pressure point because of rates of change. And a lot of that is informed by these labor components over here being well elevated into their recessionary areas and seeing what we're seeing with debt. That's kind of what's informing my view. And, when we think about, where's one of our charts here? When we look at this one, when we look at the rate of job growth, and we see that it's still rising, but that there's periods in the past where jobs have stayed positive for many months and we've still had recessions, but we see these other components starting to flash warning signs. It's hard for me to look away. By the way that I look at this data, it's hard for me to look away. I had an hours worked chart. I wonder if I've still got it on here. I got rid of it. What I wanted to show you guys, and maybe I can pull it up on here, weekly hours. Yeah. So let's pull up some of these. We're just going to open a bunch of these different tabs. Okay. It's a bunch of different sectors, and it's the average hours worked. And I originally tried to chart this for you guys, but I didn't appear to save it. So we'll just forget that I made a chart. But one of the early signs of labor weakness is a reduction in hours worked. So before jobs get cut, hours get cut. Temporary workers lose their jobs. Job openings fall. and then hours get cut, and then full-time employees begin losing their jobs. Well, if we look across the labor market at a bunch of different sectors, which we are about to, you will notice that most of them have a trailing component or a falling component to the average amount of hours worked per week. This is total private payrolls. This is all sectors put together. You can see the downtrend pretty clearly. Now it's come back down to kind of a mean area, the post-GFC mean area. So we'll see if it holds there, but it's been falling now for about 2 years. And if I go across these various sectors, you'll see the same trend. Manufacturing, downtrend. Construction, kind of holding steady. One of the few sectors that looks like this. Most of them are in a downtrend, but construction is still holding up. Utilities, falling down, now breaking down below lows of the last 5 or 6 years. Retail trade looks like Armageddon. Information services is like tech workers and things like that. Data entry people, they all fit into this kind of information group. Those hours have been rising off of relative lows. We'll see what happens with that. This isn't the sector that I would think would get hit the hardest or the earliest. Leisure and hospitality also falling. Private services, this is a big group that contains some of these other groups. Hours have been falling. Professional and business services, if you zoom in on it, it is declining, just not as dramatically. Transportation and warehousing also falling. So we see hours coming down across the spectrum here. And that's happening at the same time that temporary workers are losing their jobs on a rate of change basis. Remember, this axis is inverted. These are some of the things you can look at because this Fred website is free. And so you can go look at average weekly hours of all these different sectors. You can look at total private. That's probably the top line one that you want to look at. Or if you want to get a look at the goods sector, you can look at manufacturing of production and non-supervisory employees. Those are two really good things to look at. Also, temp help, temporary help services. It's called temp helps. These are temporary workers. That's this rate of change right here. You can go look at that yourself on the Fred website. All employees, temporary help services. This is one of the first things that you will see soften going into a downturn. It was true here in 2000. It was true starting in 2006 for the GFC. And you can see here, we have been in a year and a half downtrend in temporary workers. So we'll probably wrap up here soon. I'll go back through the chat here and I'll make sure that there are some questions. There weren't any questions that were unanswered. But I did want to just kind of riff for a second because I've gotten a couple of replies to my tweets lately. I don't know, giving me constructive feedback, I guess that's the term, for my not being more outwardly bullish when price is going up and how I seem to have kind of like a never-ending bearish bias. And I wanted to kind of talk about that because I've been thinking about it. It's good feedback. What I think is when I look at the data the way that I do, when I take this kind of big picture approach to the economy, it leads me to a relatively unambiguous set of outcomes that could arise from where we are right now, right? The strongest likelihood is a recession. The least likely outcome is that we thread the needle perfectly and 2 years from now, we're back into another new expansion despite having not truly ended the financial cycle. There is a chance for that, but the chances are very low. And when you study things, when you study the financial cycles the way that I do, you find that the stock market and the sentiment around the market are often greatly dislocated from what's actually happening in the economy itself. And those things can remain dislocated for a long time. And when the number is going up, when prices are climbing, when stock prices and asset prices are climbing, Everybody's talking about it. Everyone knows it. There is a majority on Twitter that reflexively shitpost about number go up all the time, to the point where I don't feel that I am contributing to the conversation by simply echoing the same thing that everyone else is saying. And if I didn't have this bias about the recession, you know, the way that we've been looking at it the last 6-9 months on the channel here, if I didn't have this bias, I might talk more commonly about, wow, the stock market really looks strong. But because I have this feeling that we're coming up on a negative outcome for this cycle, because I think that it is more likely than not, when I see everyone getting really bullish, my first reaction is, what are they missing? What could they possibly be missing? Because everyone seems to agree that we should be bullish. Everyone seems to have abandoned their recession calls. Soft landing appears to be the consensus. Like, let me just show you. Let me close all these tabs. And this is just me riffing with you guys. I don't have like a speech prepared for this here. I'm just kind of going off the top of my head. Let me look at my friend James Lavish. He shared something a couple of days ago. Where is it? Look at this. He has a Bloomberg terminal. I do not. He searched for soft landing, and just in the 2 days before his tweet, there were 20, 30 articles about soft landing. And if you look at the titles of these articles, every single one of them is cheering the soft landing. Almost 0 articles are about how the soft landing is not likely. Everyone has bought into it. It is consensus. When you look at that tweet from Eric Balchunas, look at that. Record inflows into the NASDAQ this week. All-time record inflows, right? We looked at Helen Meisler just a minute ago. Lowest put-call ratio ever, or since January 2022. Everyone's buying calls. I don't feel like I provide value to my audience or to myself by simply seeing that everyone is bullish and tweeting out my own like little meme about how the number's been going up and how everyone should be bullish. Because people are often wrong. Recessions often begin from market highs. And when you look at valuations, when you look at forward earnings estimates, when you look at breadth in the market, if you look at the S&P and who has been gaining relative to the market, it's a concentration at the top of the pie, right? Like if you look at the S&P over the equal weighted index, it's all the way up here at highs. It's at 2020 highs. That's market cap concentration. That's market cap leadership. That's the top 20 stocks leading the rest of the market. But go look at the Russell. The Russell has gone nowhere, right? Go look at micro caps. They've actually broken down in just the last couple of weeks, right? You go look at mid caps. They also are not on a bull market. But then if you look at the mega caps, they are. That's not healthy. You go look at credit. It's all the way down at the lows. Whether it's high yield or investment grade, it's all the way down at the lows, right? Credit growth has been completely choked off. I see all of these things. And like, yes, Bitcoin is up. Yes, there is clearly an alt season. I don't need to tell you guys that. I don't need to be the guy tweeting, Bitcoin is up 5% today. Like, who cares? I don't provide any value at all doing that. There are 50,000 people doing that. I try to look where people are not looking. If it doesn't seem relevant at the time, I just don't say anything and I just assume, well, there's nothing, people aren't missing anything. This is bullish and numbers going up and that's great. However, there's a lot wrong. And, you know, in my estimation, I think we're living through an illusion of sorts right now that is heavily catalyzed by the amount of money printing we did a couple of years ago and the fact that we have inflation as a component in this market for the first time in 40 years. So it's a very difficult scenario to read and to have a clear bias on, because a lot of the things that have lined up don't match any prior era. But there are certain dynamics that you do see if the market is actually bullish on a more prolonged basis, on a sustainable basis. And if it's bullish on a sustainable basis, then things like the 2,000 smallest companies in the stock market don't look like this. And that's been true for decades. That's not just a QE phenomenon. There was something I just saw. Where is it? Where's my friend Michael Arrowhead? %40 of the companies in the Russell 2000, this chart right here, 40% of them have negative earnings. And we're supposed to be at the start of a new bull market. It's basically almost half of the Russell has negative earnings. That's basically a back test on the GFC high. You see that? Look at that. Like, we basically are at the GFC highs in terms of unprofitable companies in the Russell. So I don't think that this is sustainable. And I don't think that I bring a value to the audience, and I don't learn anything by just becoming a Bulltard cheerleader like I'm at a pep rally. I'm not denying the uptrend. I'm not sidelined and sad. I'm not shorting into strength repeatedly and getting rinsed. Like, I'm not a degen trader, you know? It's backed by research, a lot of research that is completely transparent and in the open that I've been sharing with you guys since I started my channel. And it informs me of a bias that has yet to be invalidated. And so when I see everyone getting super bullish on the S&P with, you know, the lowest put to call ratio of all time and the highest inflows in the NASDAQ of all time, while the S&P is in a retrace with real rates at their highest level in a really fucking long time, here are real interest rates, then it's hard for me to buy all the bullishness. I feel like people are missing the forest for a few really good-looking trees. And that's hugely concerning to me. And that's why I tend to go, hey, don't forget this thing. You know, when everyone gets really excited, I will tweet out a meme sometimes. You know, when Bitcoin broke above 32K, I tweeted out Nick Cage from Con Air with the wind blowing in his face. You know, I can join in the party, but it's not in my nature to just be a cheerleader. I'm not going to be some low information guy who just tweets out every news story when it hits. Oh, CPI came in at 3 today. Oh, consumer credit came in at 1 trillion, where I give you like the play-by-play of the economic calendar, and I do a little write-up every day of like what the new Red Book number said. I'm never going to be one of those guys. If it's not interesting and it doesn't have an impact on my view of what's going to happen, or I don't think it's materially significant to move the market or to move the economy, which is a big piece of it, then I'm just not going to talk about it. Those things aren't interesting to me. I'm not a news service, you know, I'm just a guy, and my content is my learning. So if it's not moving the needle for me, then I can't get excited and passionate about it and do my best work telling you about it. So that's where I come from with these things. I am bullish. I'm bullish Bitcoin. I still have Bitcoin from the last bull market. I bought last year. I've got a spot bag. I'm currently long on a trade. But none of that, zero of that, invalidates the recession thesis. None of that makes me feel good about 2024. I think we're going to have a recession. If we do, small caps will break this level. They'll go down here to the COVID lows. Most likely, the S&P will break this level, because that's what it does in every fucking recession. It breaks the lows of that cycle, and it goes down, and it takes out a low from 3 years or more away. Many times. This low is barely a year old. If that happens, I gotta believe Bitcoin's gonna do the same thing. People seem to think that that's impossible. Bitcoin just went 40% in 3 weeks. You don't think it can get down here in a couple of months in a recession? I got news for you. It absolutely can. It's not a guarantee. It's not something that I would sit around waiting for as an investor. Like, there's absolutely no logical reason why you hear somebody say, well, if we have a recession, we could break these lows, and you just don't own anything, and you just sit around with your cuck bucks waiting for the market to give you a price that starts with a 1-4. No one behaves that way, hopefully. If you're behaving that way, you have a lot of learning to do, and you shouldn't be taking advice from me. But saying that it's likely we go down here is realistic if we have a recession. And the odds of us having a recession are extremely high. They're not guaranteed, but they're probably over 80% at this point. Over 90%, perhaps. It's hard to put a number on it. But I'm never going to be, I'm not capable of being, because it's boring to me, being one of those people who sits around watching the news squawk, and every time there's some headline economic number, I send it out to you. Every time the S&P is up 2%, I tweet about it. Every time Bitcoin has a $500 green candle, I tweet some little nugget of wisdom from a fortune cookie about sound money with hashtag BTC. I'm not that guy. I will never be that guy. So yeah, when number goes up, sometimes I say bearish stuff. When the number goes down, sometimes I say bullish things. But lately it's been overwhelmingly bearish, because my bias is strongly favoring a recession outcome, because that's what the data says. And I am informed by data. I'm not informed by feelings. I don't care what people on Twitter say or think about my analysis, because it is all informed by the data I use. And I share it with you so that we can talk about it, so I can get feedback from you, what you think, and we can learn together. Because no one has the recipe. No one knows what's going to happen. But history is pretty unambiguous about it. And so if you're looking for someone who's going to sound like they are perfectly in tune with the near-term trend of the market at all times. So when we've had a couple of green days, I sound real excited, and we have a couple of red days, I sound really, dejected and defeated. You are on the wrong channel. That's not going to be me. But I tend to get asked that question in a way where it makes me think that people expect me to be that way, because maybe others are that way, or maybe they think that I'm wrong because I'm not sounding super excited when Bitcoin's at $36,400. I have reasons to be. And frankly, if I'm right, why would I get super excited about BTC here anyway? Like, if I think that we're going into retracements, how far away are we from them? What is the risk reward? Like, if you're not already long Bitcoin at this point, and you're someone like me who suspects a strong likelihood that price up in here will not be able to continue because of economic headwinds, then why would I convince my audience to long the corn right now? Like, that feels irresponsible to me. We should have been more bullish here. Maybe I should have been super bullish on the channel here. Guys, buy. But, 3AC collapsed, and then FTX collapsed. And even though on-chain said Bitcoin had bottomed, I didn't know what was going to happen. I was experiencing all these things for the first time. This was my first Bitcoin bear market. And I didn't want to send my audience in the wrong direction. So I just try to stick to the data, and not get too wrapped up in what my bias is. Because what my bias is doesn't fucking matter. Maybe I was early. That's possible. Evan Casey, I agree with you, just a tad early. That's true. And if we're being honest with ourselves, we've been talking about the recession since the end of last year. And this year, 2023, has been largely an up year for markets. Obviously, right? So If you're someone like me, if you were in December and saying, I think a recession is likely near the end of next year or early 2024, which is what I said, and I haven't wavered. I didn't say we were going to have a recession in March of this year. But I missed this move in terms of calling it, in terms of saying, well, it's a year away. We're going to go up until then. That was hard to see back here. That was really hard to see that. And especially when you're someone like me who doesn't have the kind of toolkit that lets me predict price action. Some people are good at that. My buddy Blockchain Backer is legitimately one of the best people on planet Earth at doing that. And he gets it wrong sometimes, but he gets it right a lot. And he's one of the best on Earth. I don't have those skills. I haven't developed that skill set where I can look at this and do some like wave counts and some fractal analysis and go, the bottom's in. Like I haven't gotten there yet as a trader. Maybe I will. Maybe I'll learn enough from him that some point in the future I can do that too. But I don't, right? I just have to use the skills that I have developed. And at the time, this said, we're going to have a recession in the next 18 months. And that's what I talked about a lot. But what I missed was saying markets will probably climb in the interim. I missed saying that. So that's the learning for me, I guess. And I'm rambling a bit here just because I just kind of want to let you guys into my thought process. I'm nobody special. I'm just a dude at my house in the great state of Texas who has a live stream. And I'm good with charts. I don't know what's going to happen any more than the next guy. I don't have decades of experience as an investor. I've only been in crypto since late 2020, early 21. So, I'm still learning and I'm going to get a lot of things wrong, but I try to give it my best honest effort. And I don't talk about things that I don't know anything about. I just avoid it. We've created conditions that will make this an ugly recession when it didn't have to be. I think that's true. I think that there are a lot of people. I've already explained to you that I think consensus is soft landing. That is borne out by the data. It's borne out by sentiment, by articles, by put-call positioning, by inflows into the queues, by just people on fucking Twitter being super bullish. Consensus is soft landing. And the few people who still have a recession thesis use words to describe it like shallow or gentle or brief. No one is willing to say we're going to probably have a severe recession. I think we are. Annie Short says, TX, can I use the same economic indicators and overlay them on another country to see the health of it, or are there nuances that make them different? That is a really good question. So if you watch the playlist, if you're familiar with, so if you're on my channel and you watch this recession roundup playlist, we go through the metrics that the NBER, which is the National Bureau of Economic Research in the United States, they use about 7 or 8 metrics collectively to determine whether or not the United States is in a recession. They don't use real GDP, even though everyone says that. Those metrics can be used for other countries, but there isn't an NBER in other countries. There are similar groups in some places. Germany has a group whose name escapes me. I believe the UK has one whose name escapes me. And some of our modern economy allies have adopted this methodology. And so you might be able to apply some of it. But what I don't know is how much it looks like US recessions, because I haven't done that work. So I haven't studied the UK or the Eurozone or Germany specifically or Japan or anywhere else the same way I've studied the US, because the US is my home and it's the one I understand the most. And I don't understand all of the economic nuances of other countries, or what really drives their GDP versus what it does in the US. I'm not that well versed on it, and I think you kind of need to have some of that sauce to really get a lot out of the analysis. But there's nothing to stop you from looking at employment, industrial production, the ISM manufacturing and services surveys, real incomes, real personal consumption. You can look at all that stuff from other economies. And if you chart the rates of change when they're in recessions and when they're not in recessions, then you can build a model. That's what I did. I didn't use anybody else's model. I built it from the ground up on this channel for all of you to see. So there's no reason you couldn't apply the same approach to another country. You just might have to modify it. So that's kind of where I'm going to wrap up today. I just wanted to look through some of that debt and credit data together. I know I kind of messed up one of those charts in there, but who cares? We're in a really difficult part of the cycle here because my thesis has been under a lot of stress. I would say since about April or May of this year, my thesis about recession has been under a lot of stress, even though we see certain things that look like a recession, like what we've already discussed today on the stream, particularly with labor and credit. But the markets have not really responded to that yet, and rate insensitivity in the household and the business sectors have meant that the Fed's tightening hasn't really had that kind of immediate response that people were hoping for or thinking we would see. So it's made having my bias of likely recession challenging to hold and to maintain. But none of the data has invalidated it yet. We haven't even gotten close to invalidating it yet. And that is why I remain consistent in my messaging. And I want it known that I have had this exact viewpoint since the end of last year. We saw it coming, and all of the data this year on the economic side has played out almost exactly like we thought it would. The only things that were difficult for us to call, and which only matter, which is the only thing that matters for certain people, is that I wasn't bullish enough at the beginning of the year on risk assets. But, so what? I made that mistake. Can't fight the uptrend. It's clearly an uptrend. But the dislocation in risk will eventually meet the realities of the economy when they become obvious. And I think we're very near that point. I think we are at the point where a year or two from now, the end of 2023 will be when the beginning of our little gray recession bar actually starts. That's what I think. I know it's off topic, but whom did I learn to trade from and how long ago did I start? I learned to trade from a lot of people. I did the classic thing of buying some courses from people on YouTube and learning very little to nothing from those people. And that was part of my learning process, was wasting some money, wasting some time, and then losing some real money because the education wasn't good enough. And then going back to the drawing board, going out in my garage and screaming at myself and smashing my head against the wall. Literally did that. And then a week later, picking myself back up, starting over trying to learn from somebody else. I used to trade small cap equities. I used to trade, in the morning, I would trade in pre-market and right around the open. I would trade small caps, a lot of biotechs and things like that. And I really hated it. That was not the kind of trading that is best suited for me. And I didn't realize it until a little bit later, and I became more mature. But I really started that in about 2017, 2018. And then my parents passed away during that time, and I got really motivated from 2018 to late 2021. I lost both my parents, and each of those was really motivating for me. And I really, at the end of 2021 and coming into last year, I said, okay, I need to really get serious. I've said that I'm a trader. I've said that I wanted to do this. My fucking Twitter handle is TXMC Trades, and I'm still not good at it. I need to get serious. And so last year, I started learning again quietly, right? Like I don't want people to follow my trading because I'm still getting good at it. Like I don't subsist on my trading income. I'm about break even. Sometimes I get it right. Sometimes I get it wrong. I second guess myself. I cut trades and then watch them go in my original direction. Like I make all the mistakes, but I've gotten a lot better. And it's really been the last year, the last 12 or 15 months. And I cut way down on the amount of people I learn from. I used to like follow a bunch of different traders and think that I'll just absorb a lot of things from different people. And now there's only two like hardcore traders that I actually watch their content. I talk to them in private and I actively try to learn from them. And they're Trader XO and Trader SZ. Some people don't like those guys because they talk a lot of shit. They've been involved, I think one of them did like a pump and dump not that long ago on some of their followers or whatever. I don't pay attention to that stuff. I just learn from them for trading because they are the best traders in the space. I have been watching traders for almost 10 years, 8 years now. I've seen a lot of really bad ones. I've seen good ones. I've seen people who have a system that will work in any market and people who need a certain special set of criteria to even be successful. And those two guys, their style works for me. I'm someone who looks at pure price action. I don't look at open interest and positioning or volume profiles or any of this other shit. I just trade pure price action, just the charts. I don't use any indicators, nothing. And so I found those people. Their style relates to me and my type of learning. And so I have laser focus. And it helps that I became friends with XO this year. He's had me on his channel a couple of times and I've gotten to know him some. And that's really helped me a lot as well. Just having a sounding board, someone who does the same thing that I'm trying to do, who's already good at it. And I can say, hey, I'm seeing XYZ. Does that even make sense? So that's been my journey personally. But I'm still figuring it out. And I get really distracted. Sometimes I spend too much time on my economic data rather than trading. And that's been part of the reason why it has taken this long for me to really bring it all together, is because I have interests, right? And sometimes some things start happening and I need to go make some charts. I need to get into Tableau. I need to pull some data from Fred. I need to start making some new econ charts because I got to figure out what's going on. And then I'll spend like 5 days doing that and not take any trades. So like that balance has been tough for me, to be full transparency. And so I'll go through these waves where like I'll be really dialed in and then I'll get distracted because there'll be some big news event or we'll get some crazy data that comes out from some economic release and I'll get distracted again. And so I've kind of been going back and forth between like being an economic macro analyst and putting my time towards trading. And maybe eventually I'll get to a place where both of them are equally good and I'm strong in both of those. But it's been a long process. A really long one. Let me make sure that I didn't miss anybody. I definitely missed a couple of people. Let me zoom back here. Oscar Hernandez. What's up, BCB 702 crew? Hit the like. I missed you a little while ago, Oscar. Thank you, buddy. Very generous. Big supporter of the channel. If you guys want to trade, this is the best time to start. I'm not saying go put money on the line. I'm saying paper trade, learn what you're doing first. But if you actually want to learn, this is a great time. You don't want to be learning how to trade when the entire market is going up nonstop because every one of your mistakes gets rewarded. What you really want is to learn to trade when it's a chop fest. And we've kind of been in one of those. We've had some periods of multi-week trends back and forth, but this is the kind of market where you want to learn. You get to learn both ways. You can learn how to long, you can learn how to short, you can practice range trading and trend trading. Both of those need to be in your toolkit because sometimes the market goes sideways. And so if you want to learn, this is the great environment to do so. And then when the market is all going in one direction, you can trade it easy as pie. Your invalidations are clear, you ride the trend, and the market does a lot of the work for you. You don't want to be learning how to trade, if you're going to pick a time, the best time is probably not like December of 2020. Like, you make some money, but you can also get your ass handed to you if that's the first kind of market that you ever see, where things are going up 100% in like a day, just from you pushing the green button, and you don't actually learn anything. All you see is your P&L go up, and you get really emotional, but you don't actually learn how the market works. So I think this is the best time to learn. That's why I decided when the bear market really began, I said, okay, I'm going to start learning now. And I've had those moments, like I said, I get distracted. I'll get distracted for a few days at a time, but I keep coming back. And what I have spent the most time on in the last 18 months, the most time out of anything, really the last 12 months, is trading. And I will get there. Turn me into an XRP maxi. I don't think that's going to happen, guys. XRP is fine. It's a thing. I own some. But it's just not something I study. I study Bitcoin in part because I really like the on-chain data, and I like seeing investor behaviors, things like that. And I became very knowledgeable about that kind of data, and I liked looking at it. It helped me learn a lot about market behaviors and how humans operate in good and bad times. You can see a lot of that with Bitcoin on-chain, and that's given me a lot of interest in it. I'm interested in it because, no one controls supply issuance. No one controls it at all. We can only change things through consensus. And those things are just interesting to me. It's not a knock on XRP. It's not a knock on anything. I just don't find other things as interesting. That's just how it is. But I own some XRP. I have some Ethereum. I currently own a bunch of different altcoins that I bought in late October that I'm currently going to ride up into the retracements. But I'm not going to list them all out for you here because I don't want some idiot to go long everything that I've already owned now for weeks, because that wouldn't be very smart. All things shitcoins because it's funny to me, because people get really mad because there's so much tribalism in this space. And I'm the kind of person who naturally pushes back on tribalism and groupthink. If anyone ever tries to put me into a group, my natural reaction is to prove that I'm not a part of that group. I don't want to be pigeonholed or categorized or said that I'm only into X, Y, and Z, because I'm a dynamic person and I lose interest in things and I find new interests all the time. I'm constantly changing and learning. And so there is no set of words that describes me other than I am a dynamic person. So I'm not a maxi of anything. I'm not a Bitcoin maxi. I'm not an XRP maxi. I'm not a fiat maxi. I'm not a trading maxi. I am a data maxi. So I have an indicator called shitcoin dominance. And I do that because people get mad when I call them shitcoins. And that's the only reason. So, all right. Had enough of the lounge chat here. We're going to wrap this up. Not Oscar Hernandez with the late dono. Glad you're making a habit of this. Thank you, brother. I will do this every week. We didn't do it yesterday, but we did it today. I just had some conflicts. We'll do the next one next Thursday. We'll be right back in it. So if you're looking for someone who is an ace trader, who's going to be able to call the pivots in the market with a high degree of accuracy, who's going to give you full transparency to his buys and sells and update you when I take profit and move my stops. I'm never going to do that. I might share more of my trades if I find myself becoming better at it, but that's just not what I'm into. I'll share them occasionally. I'm going to get a lot of stuff wrong, but you can be assured that all of my views are informed by data, because I'm not clever enough to make things up. I'm not creative enough to conjure a story about what the market is going to do. All I can do is measure the data as it is and compare it to the past and apply my rational cashew brain to it. If that interests you, smash the like button, subscribe to my channel, enable the bell icon so that you find out every time I go live. I will be doing a live stream just like this every week for the foreseeable future. And you too can join in this ongoing process of learning, which happens in public on a daily basis. I have 164 likes. It says I have 175 concurrent viewers. That's amazing. It's a 1-to-1. I love you guys for that. So until the next time we speak, which will be next week, I want you to take care of yourselves, to take care of each other, not to pay too much attention to the news cycles. You know I don't. I haven't paid attention to a single piece of news about what's going on in Gaza. Not because I don't care. It's because I don't believe anything the media tells me about what's happening on the other side of the world. And I definitely don't think the people on Twitter know any more than that, because they're informed by the same media that I find trouble believing. So just tune down the news cycle. Live your life. Focus on your families and the things that you can control. That's what I say. And you'll be peaceful for it. But I love you guys. We'll talk in about 6 days, not 7 days. We'll try to do it next Thursday at 11 a.m. U.S. Central again. And that's where we will leave things. So with that, I bid you adieu. I hope you have a great weekend. It's Friday. Go outside, do something in this beautiful... Here in Austin, Texas, the weather is gorgeous. I hope it's that way where you live. And we'll chat again next week. We'll have some new things to discuss. Probably rant about some of the things I've ranted about before. And we'll just kind of see what happens between then and now. See you guys next Thursday. Cheers, everyone.